This is Andrew Stotz of Stotz Investment Research, and I'm looking at the U.S. market, and I am looking at what I call my FVMR Snapshot. And the first thing that we want to look at is just to understand what's happening across the world versus the U.S. We can see an ROE of about 13% across the world and a very impressive 16 or so percent ROE in the U.S. Well, with that good ROE, it doesn't necessarily make sense to pay out a lot of dividends. So right now, U.S. companies are paying out about 37% of their profits as dividends. Now, if we look at the PE, what we can see is that the world's trading on 16 times and the U.S. is on about 19 times. So though the U.S. has a very high ROE relative to the rest of the world, what we can see is that you pay for that in the PE. And PE is relatively high if we look at it relative to the long-term past. Now, the next thing we can look at is the price to book to understand the valuation. And we can see about a 2 times price to book versus almost a 3 times price to book. So on a price to book basis, the U.S. is a bit expensive. And if we look at growth, we can see 10% growth, then 12.5% growth. Now, analysts tend to be optimistic, and we can see that they are right here. Across the world, actually, growth estimates by analysts are less at about 11%. So I would say that the U.S. expectations for growth are about in line with the rest of the world, but you're going to get a higher ROE and you're going to be paying a higher price to book in PE. So that would tell me that the U.S. is a bit expensive at this point. Now, if we look at the change in price over the last year, we can see that globally, and of course, remember that the world includes the U.S. So if the world includes the U.S., it's heavily weighted. So what we can see then is that 11.7% is how much the world grew, and the U.S., how much price change there was over the past year. The U.S. about 15%. So that actually means if we were to understand that better, we could look at the world ex-U.S. and see that that actually was probably lower than the 11.7. And the gearing in the U.S. is a little bit high relative to the rest of the world at about 67%. That's driven by a couple of sectors that are really high in the U.S. And if we look at price volatility, it's about in line. So now let's just take a look at some sectors of interest here in the U.S. We can see that the consumer staple sector has about a 25% ROE. Impressive. In fact, look at these sectors all have more than 20% ROE. So very impressive performance in the U.S. In fact, what you can see is that the U.S. ROE is being dragged down by energy companies because of lower oil price over time, and we can see financials, and we can see real estate, and utilities are almost always going to be low because they're regulated entities. So overall, it looks pretty amazing. Now, if we go and look at the PE ratio for the sectors, we can see that the energy sector, though ROE is low at 6%, PE is about 32%, and we can see that EPS is massive. Why? Because this is a cyclical company. Oil price rising, we're seeing that there's going to be a rise there in earnings, but that also means earnings is low. So a high PE is actually cheap for a cyclical industry like energy. If we look at some of the other industries here, we can see that some of them are really expensive, such as here's the real estate industry. Now, if we look at the real estate on price to book, it may be a better measure because right now we can see that the earnings have collapsed for the real estate sector. And on a price to book basis, you get a more stable number. And let's say you're talking about 2.5 to 3 times price to book. The market right now, analysts are expecting that this is going to recover. And finally, let's just see if we can find a relatively cheap sector for a high ROE. Well, what we can see is healthcare is trading at about 15 times for a 21% ROE, 22%. And we can see infotech's trading on about 17 times for a 24% ROE. So that's not bad. Those are interesting and good sectors. If we look at price change right now, financials have been roaring back along with infotech, which is all the technology companies that are doing pretty well on their share prices. And finally, let's look at gearing and understand the risk level. Some of these industries naturally have a pretty high level of gearing. We can see telecoms, we can see utilities as an example. Infotech just sits on a lot of cash on those balance sheets. They're an asset-light type of business, and so we don't see any debt that's of sizable amount. Finally, if we want to look at the volatility of the sectors, let's look at the one-year volatility. And of course, the volatility of the markets is a little bit lower because there's all kinds of stocks from all kinds of countries in the world and in the US. But if we want to look at these sectors, that's a better, let's say, apples to apples comparison. And we can see that the most volatility is in the energy sector, and also we can see in the financials. The lowest volatility is in the consumer staples sector, and we can also see in the industrial sector. So consumer staples actually is low volatility, partially because why? Because it's staples. It means the things that you have to buy, as opposed to discretionary items like a car or a washing machine or the like, which you have discretion over buying. So consumer staples would be food. And of course, most important is coffee. Yeah, that's a good consumer staple. Anyway, so that gives us a breakdown on the U.S. market, my U.S. Equity FVMR Snapshot. If you want me to look at your country, just leave a message in the comments below. Have a great day.